business acquisition, completion, and handover. Now there's two documents that can be used. One is known as an APA, which is an asset purchase agreement, and the other one is known as an SPA. So these are the two types of documents which are used to complete a business acquisition, APA and SPA. You're only ever going to use one of them. So what's the difference between the two? The difference is that when you use an APA, you're purchasing the assets of the business, not the shares of the business. So you're not buying the company, you're buying all of the assets which are held by the company, and that's what's going to be transferred over to a new company. When you're using an SPA, share purchase agreement, then you're buying the shares of the company. You're buying the company itself, the limited company in the UK, or the corporation. You're buying the corporation itself. So the share purchase agreement is buying all of that. Now, what's the difference between the two? The difference is, of course, when you're buying the assets, you're only buying the parts of the business that you actually want. So, for example, you'll be buying the plant and machinery. You're buying the fixtures and fittings. You're buying stock. You're buying. Now, when we say staff, you're not buying the staff, of course. You're buying the contracts of the staff, which. So the contracts of the staff to ensure that they now work for you, and you're buying, things like that basically to ensure that the business can run. You're buying the customer contracts. Now, when we say staff contracts and customer contracts, in many of the countries you'll have some sort of mechanism where the staff legally they have to be transferred over to the business, so to the new entity. In the UK, that's called 2P, TUPE. Now, when you're customer contracts, you have to explain to the customers. Now, you actually have to get the customers to sign new contracts with the new entity because they have a contract with the old entity, and you're asking them to sign a new contract with the new entity to ensure that they continue custom. And that's why sometimes APA can get a little bit tricky if, for example, you don't plan the customer relationship properly or customer handover properly. The staff normally is pretty okay, although we'll talk about staff in a minute. Stock, fixtures, fixing, plants and machinery, that's all actually pretty standard. So when you're doing the asset purchase agreement, you have to, and that's why in the asset purchase agreement normally there's a list of all of the assets which are being transferred over to the new entity when you're purchasing that new entity, when you're purchasing the old entity and putting it into the new entity. With the SPA, generally speaking, you don't have to do anything because if, for example, the previous business owner has done the right thing and housed all of these properly within the old legal entity, and all you're doing is you're buying the new legal entity and you're just literally changing the contact names if required. For example, if, for example, the previous owner has done the exit in the right way, meaning they've exited themselves out of the business first and then they've gone and sold the business, normally you don't even have to change the contact names. So with many of the acquisitions that we do, like for example the customer relationships, there's no difference in fact. When it comes to supplier relationship, sometimes we say, okay, instead of contacting this person, contact that person. Sometimes we leave it exactly the same. So it all depends. So SPAs are a little bit cleaner actually when you're buying, in terms of handover I'm talking about, not in terms of what actually you end up buying. Now this is another important thing. With an asset purchase agreement, or an asset purchase I should say, is that you're only ever buying the good things. Yeah, because you're only ever going to buy the good things. Yeah, so you're buying the good things of the business. Right? With the SPA, and this is one of the limitations of the SPA, is that you're buying all of the assets and the liabilities. So assets and liabilities. So there's a problem that can happen. For example, we had this problem where there was a staff member who made a redundancy claim against the business. Now, that's really not a huge problem, but the problem became of that situation is that they were making other claims against the business of wrongful dismissal. So because of that, we had this legal case that we had to take on. Literally, as soon as we closed on the business, a week later, this happened. And we had to deal with it because, of course, we had purchased the shares of the business and we were therefore liable for this claim, even though it was with the previous owners. So we dealt with that. It cost us, I can't remember how much, it cost us exactly something in the region of like £18,000 to deal with that situation. But we got maybe even more than that, it might have been in 20. Whatever the case is, water under the bridge. what you get to know with a share purchase agreement, you're buying the shares, the assets, and the liabilities. And we can put it in this way: you're buying the good and the bad. Good and bad. And ugly of bad things, yeah? So that's the difference. So with all of these, your lawyers are going to be working on it. You have to ensure that your lawyers are taking the lead on this. And also with both of these, actually, you don't want to have a long agreement. The best situation is always if you have a shorter agreement to ensure that it's like simple. Now, I don't mean that you don't have the necessary protections that you need. Now, for example, you always need to have tax protections. So you need to have tax protections to help you be protected, basically. So, for example, when I say tax protections, with an APA, actually, it doesn't even matter too much. Although, if, for example, there's been malpractice by the old owner, sometimes the HMRC and IRS can come under the new owners. They can come after the assets. They can't come after the owners. They can come after the assets. Because if they've been missold out of the business, for example, HMRC can come back and say, look, you know, the previous owner has done this and sold them a fraction of the value, and therefore we have right over this asset. Now, of course, you can fight that in a court, but do you really want to go to court with HMRC? Do you really want to go to court against IRS? You don't really want to do that situation. But you want tax protections mainly in the SPA. That is the biggest one. The tax protections are absolutely huge, and you know, if your lawyer does the right job, they can actually have really good protections. So normally, what actually happens in the SPA, this is negotiated from sell side, is that sell side want to limit their liability, and of course, what you want to do is you want to ensure that there's maximum protection against liabilities. So you want to maximize protection. And ultimately, what I find is that the biggest negotiations when it comes down to the SPA and the APA is around these two elements here. So how much is the seller limiting the liability and how much are you maximizing protection for yourself, meaning putting the liability on the seller? That is where the biggest conversations happen with regards to these two documents. So what you want to do, make sure that your lawyer is taking the lead on that, but ultimately you have your entrepreneur hat on and ensure that you're making sensible decisions to get it to completion. Because you can work, you've done all of this work, finding the business, negotiating, making an offer, have the offer accepted, drafting the letter of intent, heads and terms. You've done all the due diligence, you've done all of that hard work, and then right at the end, and it does happen, by the way, it happened to us many times, or not many times, but a few times, where in the last week of completion, the seller pulls out. And by the way, that's not always your fault as a buyer, because seller's remorse is one of the big reasons why sellers pull out of a transaction. Because even though they thought that they want to sell a business, when it comes to the crunch, when it comes to the time of completion, they feel that they can't go ahead with it. And you'll find that many times is that sellers, they'll say, it's not you, it's me. Right? That standard excuse that is used in relationships is all right, it's not you, it's me. So the sellers then pull out, and then you've spent all of this money on due diligence. Remember, the buyers are normally, us at buy side, for example, for the purposes of this video, we're spending all of the money on due diligence at this stage, right? So we're spending the money on the SPA or the APA, and we're spending the money on the due diligence, and we're putting all of this energy in to get this deal to completion. And the seller is actually spending little money compared to us. So compared to us, their spend on legal costs and accounting costs is normally smaller. And therefore, it's easier for them to pull out. And ultimately, they have the asset, the business, right? So if they have the asset, they have the power, and they can pull out at any time. This is one thing that you need to be careful about as a buyer. It's always about re-courting. What do I mean by re-courting? You're always continuously selling the seller on completion. So the best way to do that is to paint the picture of what life is going to look like post-completion, and have to make that more attractive to the seller than what they are in right now. So their post-life completion needs to be more attractive than current completion. Now, another thing that you need to be aware of on buy side is that, and sell side, is that last minute negotiations at the 11th hour are common. Now, the good thing is that normally you're putting something onto the seller. And like I said, seller's remorse is very, very big consideration that they can pull out any time. And you need to be careful about this, because what you need to do is that you need to negotiate to your benefit, without killing a deal. Without killing, and I'm going to put this here, the deal. Now, in a previous video, I've talked about don't be afraid to kill a deal. Normally, you want to kill a deal early on in your due diligence stage, because what you want to do, you want to sniff out malpractice, fraudulent activities, good faith and goodwill in a deal early on. If you've got to the stage where you're almost at completion, you're in the last week of completion, then you have navigated that whole situation and you want to get the deal to completion. You don't want to kill it on your side. So early on in the due diligence stage, when after you've signed the letter of intent and the heads of terms, you want to kill the deal if it's a bad deal, or if you feel that you're going to lose more money by completing the deal. When it comes down to this stage, the threat is now from the sell side. So the sell side is more likely to kill the deal when it comes close to the completion. And you want to complete it because, of course, you've got to this stage of the deal, which means that is a good transaction to go ahead with. So what you want to do now is to negotiate to your benefit without killing the deal. And by the way, the best way to do this, without any exceptions, is to literally get you and the seller, meaning the decision makers of the sellers, because you've got multiple parties, one of them, or they're going to be the decision makers, lock yourself in a room. And, basically thrash it out. And this is funny because we've had this so many times where the lawyers are locking heads, they're locking horns for like ages, right? On these particular clauses that are in the SPA, they're in the APA, they're in the lease agreements, whatever it may be. And they're locking horns and they can't get to any conclusion. So what I normally do, I'm like, right, Mr. Seller, Mrs. Seller, let's get into a room, get our lawyers on the phone, get our accountants on the phone. We've got 4 phone lines running at the same time, or accountants with me, my CFO's normally with me. So we're all in the same room now and we're just basically thrashing it out to get these things that they've been talking about for the last 3 weeks to get to some sort of conclusion. And we normally thrash out like 3-4 weeks worth of problems within that one sitting. And that's why you and the seller getting yourself in the room and locking yourself in the room and throwing away the key and say, right, no one's leaving here until this is sorted. That's the best way to get this. So you can negotiate to your benefit in this way. Because if you are good at acquisitions and you're good at selling, then you can say to the seller, hold on a second, you said this, but actually through our due diligence we found that. And you have to convince them on your due diligence findings. And this happened once. We found in a business we were doing, we didn't actually complete on this because we found, and this is one of the unique situations where we got to the end of a deal and we found so many things wrong with the business that we thought, we have to pull out because it's just going to be a bad deal. Anyway, so we found so many things that were wrong with their assumptions about their own business, and we told them that, look, all of this is wrong with your business. And we actually done this in a very clever way. If you can do this, by the way, this is a top tip. You can get their lawyer and you can get their accountant and you can get them in a room and you can say, right, this is, we found this. Is this your opinion that their business is operating incorrectly? And if you can get their lawyer and their accountant to agree with you, the seller's now left in a situation where they can't do anything. Yes, because their own lawyer and their own accountant is now agreeing with you as a buyer to say that the seller hasn't done something correctly. And by the way, if that's the situation, there's too many of them. There's big ones, and that's in that particular acquisition that I'm talking about. If there's big things that are wrong with the business, there's no harm pulling out at the end as well. So you don't want to kill a deal unnecessarily, but don't be afraid to kill a bad deal, because it's better to lose 10,000, 20,000 now than to lose, 200,000, 500,000 later. Yeah, you don't want to do that. You want to get everything to completion and to do last minute negotiations to your benefit. You also need to be ready for third party delays. This is the most annoying thing as both a buyer and a seller. third party delays, because they're not you, it's not you as a buyer, it's not them as a seller who's delaying this thing, it's some sort of third party. So what do I mean by this? I always give the same story. My first transaction, we were all done Friday evening, everything signed, everything done. We're all waiting for my investors to now deploy the money, to draw down the money and to give it to our solicitors, who can then pass it to the next solicitors. They did not release the funds. Imagine that situation. Your first transaction, and the people that said to you that they are going to give you the money, at the time that they need to give the money, they didn't give the money, and they said they refused to give the money. Now, Friday evening is kind of a best time for that to happen, is because even if they did try to transfer the money, it probably wouldn't happen till Monday morning. But in that particular situation, there was, some things that were wrong on their side. So the business that we were buying, for some reason, was trading under 3 limited companies or 3 entities. I don't know why. And the investor said, "Oh, you didn't tell us about this," even though we did. So I showed them the error of their ways. In any case, they said, "Right, we need all of these things." So Sunday night, I done some of them. Monday morning, I had my checklist challenges just to sort of go through them. And then we got the funds released on Monday morning. Now, that's not too bad, because it's from Friday evening to Monday morning. You can't really do much on the weekend anyway, when it comes down to lawyers, accountants, investors, banks, and so on and so on. But in another situation we had where there was the accountant went on holiday. Okay, that's a third party delays. You have to be ready for this, right? So annoying. So accountant went on holiday for I think it was 2 days. Right? Now the accountant went on holiday. When he returned, the lawyer went on holiday. Now when I say holiday, he was off for a day. Right? Sell side. And so basically there's 3 days delayed. We thought we were going to complete on, let's say for argument's sake, it was on a Tuesday. But now because of these, we're now completing on a Friday. No, they didn't bother to tell anyone. They didn't even tell the seller. Right? Their own accountant didn't tell their own client that they're going away for 2 days. And the lawyer didn't tell them that they're going away for 1 day. Now, the super annoying thing that happened in this particular situation is that there was a the seller was also the landlord of the premises who was issuing us a new lease, right? However, it was in a trust. So the property was in a trust, and of course that means that there's a trustee who is handling the trust on behalf of the seller. And the trustee went away on holiday as well. Oh, I couldn't believe it. I think it was 2 days or 3 days. I can't remember. Let's just make it worse. Let's say they went away for 3 days. It was so annoying. And it's communication, guys. Communication. That's all you need to know. So this is a particular situation that happened to us. Right? A real live situation. And another thing, I'm actually involved in a local charity in my local area. And in that situation, there was, again, a series of holidays, people going away and so on. The landlord actually was a Jew who had one of the Jewish festivals. I can't remember which one it was. So they said that they couldn't work for 4 or 5 days or something as well. And there was literally a 3.5 week delay because third parties were something or the other was happening. So you really need to be prepared for third party delays. And the main thing you need to understand here is that you need to hold your nerve. You need to hold your nerve. Because it's so easy to lose your cool. And everything in business is about being emotionless. And when I say emotionless, is that you use your emotions to your strength, but don't let your emotions overcome the business decisions that you're making. And third party delays is so annoying, then it's one of those situations that your emotions can come to the fore. Now sometimes it's good to show anger, sometimes it's good to show frustration, because it shows your lawyers and your accountants and the seller, for example, or investors, whoever it may be, it shows them, right, there's urgency which is now here. But to go over the top, to go and kill the deal because of emotions, then that's not the right thing. By the way, one thing is that when it comes down to, if you're on buy side, you need to be wary of sell side emotions. If, for example, there's going to be some sort of long-term relationship thereafter. And when I say long-term relationship, I mean even if, for example, they're going to be involved of anything more than 2 weeks of handover, any type of handover, you need to be wary of seller emotions is because they can blow up and kill the entire situation in the business. So we once had a seller who stayed on into the business, and this person was very emotional, very like they were very colorful with the emotions, and everyone knew what they were thinking. And that person, like, almost, I wouldn't say that the people were going to leave, because that wasn't going to happen. The staff were very happy in the business, they were very happy with us, but it was just a bad environment in the business because the seller had, these colorful emotions. So you need to be wary of that if there's going to be some sort of long-term relationship, because it can kill the deal. It can, when I say kill the deal, it can kill the deal meaning they can pull out, and it can ensure that, some of the staff members, key staff members, end up leaving because they think, oh, this is how it's going to be with the new owner. They're going to put the blame on you. Now this brings us swiftly on to the next point. You need to reassure staff that their jobs are safe. This is very important. Now, before completion day, you should have met the key team members. So before completion, you should have met the key team members. So the staff only care about one thing. Now remember, staff are super important because a business is a group of people who make this business happen. Generally speaking, you can have some sort of businesses where there's only 1-2 staff members, easy to replace, but generally speaking, the staff members who make the business run. The staff only care about one thing. What's happening to my job? What's happening to my job? That's the big question. That's the only thing that staff are thinking about. Now, the funny thing is that when we meet staff members or we meet the management, so we say to them, look, everyone's job is protected. And by the way, you need to tell them that even if their job isn't protected, because you're not going to fire everyone on day one. If you're, for example, planning to make redundancies, you're going to fire them over time. You're going to make them redundant over time. So what's happening to my job? You need to reassure them. You need to give them reassurance. Reassurance. Because if all of the staff members leave, you don't have a business really, right? You don't go into business, or you don't buy a business to then be the main person. When I say be the main person, obviously if you're an operator, you want to become an operator, that's fine. But you need your team members to ensure that they continue doing what they're doing to ensure that the business is a success. So the staff members, you meet them before and you reassure them that everyone's jobs are safe. But even after completion, on completion, this is the number one thing that they have in their mind. And we found that it takes about 2 weeks for staff to be completely comfortable that their jobs are safe. Now, the crazy thing is that you can go and end up firing them, make them redundant, make half of the team redundant in a month's time or 2 months' time. But it takes about 2 weeks. So the first initial time is just about reassuring people that don't worry, carry on doing what you're doing, continue doing what you're doing, and you're here, even if they're not going to be here. So that's why you need to meet with the staff members to keep them calm, to ensure that you have a good business moving forward. Now, before all of this, of course, you need to ensure that the investors and the lenders are going to deploy the capital. So normally you need to give these investors, lenders, whoever is going to be deploying capital, at least 48 hours notice. Not notice, but 48 hours to deploy capital. And that's if you've been in constant communication with them throughout the due diligence process that expected completion is in 1 month's time, expected completion is in 3 weeks time, expected completion is in one week's time. So then they know that they're building up, okay, that's fine, we need to be able to deploy capital at this time. So generally speaking, the lawyers want funds in their account cleared 24 hours before, but sometimes there's banking restrictions on how much money can be transferred through the system. So that's why if you give about 48 hours notice to your investors and your lenders to say, right, can you please deploy the capital into our solicitor's account, then that gives you enough time to go and do a completion on that day. So now that the funds are being deployed and you've signed on the dotted line, signed the APA, SPA, lease agreements, whatever it may be to get the deal done, there's 2 main things that need to be done now. The first thing is that you need to get legal control of the business. So legal control of the business, of new business, right? And normally your lawyer or your accountant can do this. So they will make the necessary filings in the UK on Companies House, in the US with the necessary, whichever country you're in, with the necessary authorities to get legal control of the business. So normally what happens is that you have this business that you acquired, business target, we call it, right? And you have your holding company, so a holdco. And then what happens is that this business now becomes a subsidiary of your holdco, right? So this business becomes a subsidiary of your holdco. So what that normally looks like is that you want to appoint a director on the business, and you want to have holdco have 100% shares control on the business target, and that's how it works to ensure the best legal structure of creating a group of companies. And then that way, for example, we're not getting into taxation or anything like that, but you can move money around this. You can move money up here, you can move that money down there, you can move money here. Well, normally you don't move money like that, but you move money through the holdco. But that's fine, because it's all under a group structure, and that's the best way to have your entity set up. So you appoint a director, you get 100% share control under the holdco, and that's the legal control of the business. Now, once you've got legal control of the business, that's when the banks and all of the necessary payment process, you need to now get financial control of the business. Financial control of biz. So that means banks, number one, get control of the banks. Now, by the way, if you're doing an APA, you're going to have a bank account already set up, and you're going to have to contact the customers, you're going to have to contact the payment processors. Okay, let's just go through this one. Payment processors. I don't know how you spell that. Payment processors, customers. Yeah. Any finances. Yeah. You need to contact all of these people, and you need to say, all right, if you're doing a share purchase agreement, all you need to do is you need to get control, meaning that the director is the person who controls the bank relationship. The director is the one who controls the payment process relationship. The director is ultimately the one. Now, customers is a little bit different, because with customers, they're going to continue deploying that. Now, ideally, there's no communication that you need to do with the customers, ideally, because the staff are already having that relationship with the customers. Because it's actually a big problem if the old owners are the one who control the customer relationships. That's a big problem. So ideally, the staff are already controlling that. And finances is like, for example, sometimes if you have a lot of outstanding invoices, some people use invoice financing to just unlock cash flow in their business. So if that's the situation, you need to get contact with the finances and say, look, we're the people who now ultimately have control of this business. So if you have any questions, any big high-level questions, then contact us. So you need to get financial control of the business. The next thing you need to do, so banks, payment processes, they're the two big ones. Customers and finances, they're normally handled by the staff. The next thing that you need to do is that you need to get security control of the business. Control. What do I mean by that? That means logins and passwords. Now, again, staff members should have this, but most sellers actually keep that close to themselves. So what you want to do is that, number one, change all of the passwords. So change all passwords. Why? Because the seller is going to know the passwords. They're going to know many of these passwords off by heart, right? So do you want someone to be able to easily go into the bank account and use a username and a password? Or do you want someone to have easy access to the website, for example, which is so important these days, right? To be able to go into the website, use the username and the password, and just access the website and mess up the whole thing. No. That's why you want to get logins and passwords and change all of the passwords. For example, if there's any, keys. Now, by the way, I have a set of keys. I have a cupboard, and in that cupboard there's a little, safe box, and I have so many keys in there.
but I've not once have ever, or actually one of the businesses I've used the keys once, but I've never really used the keys. So I just take control of the keys. I think I just want that personal knowledge that I have the keys, but I've never had to use them because obviously I don't work in the businesses. So keys, alarm codes. So what you want to do is that you want to ensure that the old owner doesn't have access to the alarm codes, that the old owner doesn't have access to the keys. Now, if they're the landlord, then they could have access to the keys, but they're not allowed to go in and visit the premises without your prior permission, right? I can't remember what the standards, the clause is something like, they're not, whatever it is, they're not allowed to come without your permission. So you need logins and passwords, keys, alarm codes, change all of the passwords, financial control. Well, there's something else which is missing from here. It's missing from here. That's what it is. So important these days. IT systems. All IT systems, website, and social media. And socials. Because most businesses have a website now, and most businesses have some sort of social media presence, and every single business has IT systems. Even if, for example, they're living in the archaic old days and using pen and paper for a lot of things, and you'll be surprised the amount of business owners who are still using pen and paper to do simple like accounts receivable work is unbelievable. Yes, it's just so much. Now that's going to change over time, as I think in the next 20 years that will probably die out, because everything's going digitalized now. But there are still people who run a paper system with a digital system. So get IT systems. And by the way, if they are running a paper system, you need to get all of that paperwork. All paperwork. Sometimes I will walk into a business and they've just got like this huge, giant cabinets of paperwork. Like, what is this? And then you find that there's a system which houses the same thing. So what you find is that they get the system and they take the data off the system and they copy it on paper and then they file the paper. Where they could have, if they wanted to, for example, just press print. Yeah. But they're manually writing it down, People are people. So that's the IT systems. Now, when it comes down to handover, you got statutory legal control, you got stat legal control, you got financial control of the business, you got security control of the business, you've got logins and passwords, you've got ITs and systems, staff members you've met, so let's just keep staff here as well. Somewhere, staff, just put that there, right? And when I say staff members, you don't need to meet everyone. Of course, if you're buying a business which has, anything more than 50 employees, there's no point having a meeting with everyone. Just meet the senior management team. If you've got a business that you've taken over which is less than 50 employees, then it's quite easy to get everyone into a room and have a meeting with them and just introduce yourself with the new owners and so on and so on. And that's really important, Saying that, the last business we took over, I haven't actually met all of the team members myself. However, my colleagues, my heads of departments and so on, they've met all of the team members. So you need someone, and this is another thing. Actually, we're going to leave this one to integration. So this is going to be integration masterclass that we're going to do. So what's the difference? Completion and handover is ensuring that the deal gets completed and then you get ultimate control of the business. That's what completion and handover is. Integration is now what you do with the business after you've got control of the business and how you move it forward into the next stages or the next stage of that particular business, of you owning the business and moving that forward to greater heights. So that's the difference between completion, handover and integration. So that's it for this video. If you want to find out more about acquisitions, increasing enterprise value and exits, continue watching videos on the channel. Like always, I have a link in the description. If you're a business owner, if you're a high net worth individual, you want to complete acquisitions, get in contact and we can see if we can support each other to get a deal to completion. Otherwise, I will see you in the next video.